All right, welcome back. The Consumer Price Index was released today, and the markets reacted to it. Joining me now to crunch those numbers, what this means for the Federal Reserve is Ben Ayers, a senior economist at Nationwide Financial. Thanks for being here. Really appreciate it.
Thanks a lot.
We haven't seen you since one of the last reports here that came out, and the number today was 2.9%. So we saw the market react to this today. So 2.9%, how was that compared to what was expected?
Sure, it was a little bit softer than we expected. You know, you look at the details, food prices went up, gasoline prices went up. Nobody likes to see that. But when you look beyond those two factors, many of the other core underlying parts of the inflation story were a little bit softer. So we're looking at things like housing, service costs, some goods cost as well. We're just a little bit quieter than we were expecting. And obviously the market has reacted quite positively to that. And it will be a big discussion point for the Fed as we look out over the next couple of months.
Yeah, so really, like you mentioned, gas prices and fuel, energy, that's what kind of dragged it up. The market really loved seeing that.
Yeah, well, they just love seeing the underlying prices, so see some softer numbers. So we've been waiting for cooler numbers from housing, from shelter, and from services. These have been the parts of the inflation story that have remained elevated, and why we're still talking about inflation still running about, as you said, 2.9 to 3% over the past years, mainly those housing and services side. And with seeing a little bit of a cooler number in December, it just hopefully sets the stage for some better numbers here in 2025.
So walk me through the end of 2024, what the Fed was doing, what their plan was, and then kind of how inflation kind of ticked back up again, and now where do we end up?
Sure. Yeah, the Fed put through 3 consecutive rate cuts. It was a total of 100 basis points. And it was just a reaction to saying we feel very restrictive with our policy, want to cut back a little bit. There was never any intention to go really low with rates, but they just wanted to cut back a little bit on the rate environment. Things have shifted, as you said now. We've had a little bit of a hotter reading over the fourth quarter of 2024. We have some uncertainty as far as where prices will go over the first half of this year. So we're expecting the Fed to be in a holding pattern for a little while, for at least a couple more meetings. The Fed meets 8 times a year, so there's 4 meetings in the first half of the year. They might not cut at any of those meetings. We might see them hold off for several meetings at least until they decide to lower rates again.
So you think they're pausing?
Yes. Yeah.
For a few meetings at least?
Yeah. And that's general consensus around the market right now is that there's a lot of uncertainty as far as what's going on with prices, and we've seen things pick up, and the last thing they want to do is reignite inflation and get that back out of control. They want to make sure they can get those readings back to the 2 to 2.5% range that they'd like to see.
And Ben, very, very quickly, now they're going to pause for a few weeks or a few months. What does this mean now for our mortgage rates, our auto loans, anything like that?
Yeah, unfortunately, that means they're going to remain pretty elevated over the first half of the year. We're still optimistic that as we go into the second half of the year, we will see some cuts at that stage. We'll start to get some more downward pressure, but at least for now, remaining pretty elevated.
So second half of the year. Yeah. All right. Ben Ayers, senior economist at Nationwide Financial. We appreciate you being in here and crunching those numbers for us.